The income available to the individuals in the form of labor income or capital income, or to the productive units in the form of retained income, or to the government in the form of taxes, is then spent. This utilization of the income can take various forms, namely private final consumption expenditure, government final consumption expenditure, and capital formation, comprising fixed capital formation and stock accumulation. Let's look at each of these Indian expenditure components in detail. The household consumption expenditure, referred to as private final consumption expenditure PFCE in National Accounts Statistics, consists of expenditure by households, including non-profit institutions, on non-durable consumer goods and services and all durable goods except land and buildings. The durable goods are defined as those whose lifetime are more than 1 year and consist of items such as furniture, radios, televisions, automobiles, etc. Purchase and construction of residential buildings are not treated as consumption expenditure of the households, but are included in the gross capital formation. In the case of owner-occupied buildings, the imputed rent is included in the final consumption expenditure. Let's now have a look on the numbers under this category. The concept of government consumption expenditure has been debated by economists for a long time. The role of the government in the economy is essentially different from that of enterprises and households. To cite a few examples, the government offers services both to entrepreneurs and consumers, and in most cases it receives no payment for that, or even if it does receive payment, the same is likely to bear little or no relation to the value of the services to the user. In the course of organizing collective services such as defense, justice, health, and education, government purchases the services of its officials and also many non-durable goods and other services from other suppliers. Since these services are rendered free, these do not appear in the household consumer expenditure. These services are not only of economic value but also create real final consumption value to the people. It is therefore necessary to reckon them in the national expenditure. Once it is agreed to include government services as part of national expenditure, it would be necessary to find methods for valuing the services. Since these collective services are not sold, they can be valued in money terms only by adding up the money spent by the government in buying these services of teachers, doctors, public administrative employees, the armed forces, etc., together with the goods and other materials purchased. This total is the consumption expenditure of the government. Gross capital formation consists of the acquisition of fixed assets and the accumulation of stocks. Fixed assets are physical productive assets, examples of which are buildings, civil works, machinery, vehicles, etc. The stock accumulation is in the form of changes in stock of raw materials, fuels, finished goods, and semi-finished goods awaiting completion. Thus, gross capital formation is that part of a country's total expenditure which is not consumed but added to the nation's fixed tangible assets and stocks. Broadly, private corporate sector, by investing in machinery, equipment, structures and buildings; public, by investing in machinery, equipment, structures, buildings, transport, communication; and household, by investing in houses and residential buildings, participate in country's capital formation. Let's see what is the contribution of each of them in creating gross capital for the country. Saving represents the excess of current income over current expenditure of various sectors of the economy. Please note that it is the balancing item on the income and outlay accounts of the producing enterprises, households, government administration, and other final consumers. For the closed economy, savings equals capital formation during the year, whereas for the open economy, savings equals capital formation plus net capital inflow from abroad during the year. Saving represents that part of disposable income that is not spent on final consumption of goods and services. It may be positive or negative depending on whether disposable income exceeds final consumption expenditure or vice versa. Assuming that saving is positive, the unspent income must be used to acquire assets or reduce liabilities. Insofar as unspent income is not used deliberately to acquire various financial or non-financial assets or to reduce liabilities, it must materialize as an increase in cash itself is a financial asset. If saving is negative, some financial or non-financial assets must have been liquidated, cash balances run down, or some liabilities increased. Thus, saving provides the link between the current accounts of the system and the subsequent accumulation accounts. If saving is zero, that is, if final consumption expenditure equals disposable income, the institutional unit is not obliged to liquidate any assets or change any of its liabilities. Therefore, disposable income can, therefore, be interpreted as the maximum amount that an institutional unit can afford to spend on final consumption goods and services in the accounting period without having to reduce its cash, liquidate other assets, or increase its liabilities. Let's now see the total expenditure in the economy for the last few years.